Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 181. On today's episode, we close out January, look and see how the indexes have performed. We'll look at a couple sectors that have done well, sectors that haven't done well. We'll discuss some of the companies that have reported earnings, those that we need to pay attention to as we move along here. We'll talk about Trump's nomination for new Fed chair and how that can impact the markets. All on today's episode 181. So as always, get your mind right and let's get to work. Okay, well, welcome back to the show, everybody. Thanks again, as always, for joining us. Boy, here in Texas, I would have had the perfect amount of time to record this past week because there was a big ice storm in Texas, and I mean all over the country, really. But in Texas, we had this big ice storm, and the problem was I couldn't get to my office from my house. So couldn't get from my house to the office to record, which is where all the equipment is. And I was sitting there thinking to myself, man, I should keep some of this equipment at my house. So I should have had a little bit more foresight, and I would have been able to record an episode while that ice storm was going on. But nonetheless, here we are. Today is February 1st. We're going to discuss the end of January. The first month of the year is completed. And boy, man, there was just so many news stories over the past month when it comes to the stock market. So many cross currents. We talked about it a little bit in the last episode, but we look here at the end of the month, and we look at the end of the month, the Dow Jones is up 1.73%. We have the S&P up 1.37%, and we have the NASDAQ just eking out a little bit of a gain of 0.95%. And so this is for all the Wall Street historians. This is very important because since 1950, if the S&P 500 has been up in the month of January, the market finishes higher roughly 86 to 89% of the time. So that's good news, obviously, that to have a positive year. Definitely looks like it's going to be a little bit of a different year just based on kind of what we're seeing here versus years past. When you look at the sectors that have done the best this first month of the year, we see things like consumer cyclicals. We see consumer defense, which would be things like Coca-Cola, Procter & Gamble, things that had basically not great years the last year. Energy had a big month because of what happened in Venezuela. And so you see even basic materials, which we'll talk about. Industrials had good months. And who had bad months? Well, technology was negative for the month, which is kind of surprising. You also had financial services, which were down for the month. A lot of that is based on, Trump's announcement about credit cards not being able to charge more than 10% interest, having a 1 year reprieve on credit card interest. And then healthcare stocks were also negative. And so that is because they announced that Medicare, they're not going to raise Medicare reimbursement plans. So when you look at stocks like Humana, United Health, they all got really beat up on those on that news. And so all the other sectors, except for technology, healthcare, and financial services, those were negative for the month. All the other sectors were actually positive. So a little bit of a kind of a role reversal here. When you look at some of the technology companies that have reported so far this past week, Apple was a big reporter. They sold just a massive amount of iPhones. And so they had, I think, revenue of $144 billion for the last quarter. That's not a yearly number. That's for the last quarter of the year, which is amazing. But it looks like there's about 315 million iPhones that are in circulation that haven't been that consumers haven't replaced in the last 4 years. So a lot of older iPhone users out there that I'm not going to say they want to replace their iPhone. I'm saying they probably have to. I mean, we all, like, I'm an iPhone user. Many of you probably are. There's a lot of people that listen to this podcast that do it on Apple Podcasts. But when you look at it, there is, I mean, the software gets a little bit larger, that takes up more storage. You're basically forced at some point to have to upgrade your iPhone in order for it to work properly. So you see a lot of those coming through. This past week, we had Microsoft report earnings and Meta. And that was kind of a tale of two different stories, especially when it comes to AI. And I think that, I don't know if that's going to be the theme of this year, but you see those two. Microsoft was down 12% on their earnings, which is the largest one-day move for Microsoft since COVID. And it was a move of $357 billion to the downside. So, when you look at the size of Microsoft, their market capitalization, to lose $357 billion in one day is a pretty good amount for them, obviously. And the concern is that they're spending all this money on AI, and are they getting the return that the market expects? Their relationship with OpenAI, and you have Gemini starting to do well versus OpenAI. And so I think that this is going to be one of those themes that continues, which is, we've talked about it on many of the other podcasts, which is, investors invest money because they expect a return. And especially when it comes to the stock market, you just don't know when they're going to expect that return. But when you look at Microsoft, and you look at their Azure numbers, and you look at Copilot and their margins. So margin is how much are they making off of the sales that they make. So you have like revenue, which is sales. You take out costs of the company. So you have, what does it cost for them to make it? You have, what is the cost for them to pay people? And then you get basically what their profit is, which is the margin. And Microsoft's is starting to contract a little bit, meaning they're not making as much money, which is worrisome to the market, especially when you put it against somebody like Meta, who Meta is spending so much money. And that's kind of been the knock on them, is that they're spending so much. And like the market expected them this year to spend, I think, $105 billion on, their capital expenditures. And they basically came out and said, we're going to spend $110 to $135 billion this year, which is a massive amount. But the flip side of that is that Meta has been able to use this spending to drive growth, to drive revenue, and to actually keep that margin intact, because they're able to basically have better ads. They're having more click-through on their ads. They're having more users stop on their ads, which is going to be in, Instagram, Facebook. And so they can go to advertisers and say, like, we can target exactly who you want, and we can use AI to make sure that your ad is more effective. And so they're being able to carry that conversation out to the market, which the market and their advertisers like to hear. And so they're able to basically monetize that spending right away. And so that is kind of the story here. And when you look at some of the software companies, you look at the Salesforce, this week in particular, ServiceNow. I mean, some of these service companies are just getting really beat up. ServiceNow has almost been cut in half. I think that's probably a little bit overdone. You look, earlier I said, who's done, which companies have done better. You see industrials, that's going to be like your Caterpillar, your Cummins. These are companies that are actually building out these data centers. So you see the market basically shifting. The money is shifting from some of these technology names, and they're basically moving that money to Caterpillar and companies that they know are going to get paid for this AI build out, whether it works out or not. And when I think about this, and I think about long term, you'll get this sell off in technology. But then the problem is when you really start looking at it, you really start looking at the financials of these companies. Their margins are so good. Like, I mean, it's really hard for any other industry to compete with the margins that are in technology. And so you'll have these financial analysts and investors that'll eventually come back to them because they're just so profitable. So when I say margin, I mean profitability. These companies are so profitable that they are just, it's just hard not to invest in them when they're making this kind of money. I mean, it's just numbers that we've never seen before. And so it'll be interesting to see how this story plays out. This week, I think we'll hear from Amazon. We'll hear from Google. And so we'll have some of the big technology companies report again this week. But you just see this kind of shifting happening. I mean, I think so much money has been made the last couple of years in some of these technology names that when investors want to move into other spaces, I mean, they got to get the money from somewhere. And so they're taking it from some of the companies that they have done really well in, and they're kind of shifting it around, which means that you might later on be able to buy some of the companies that you've been looking at. The Microsoft, I mean, that's going to get to be where it's a little overdone. And that's why it's so important, as we've talked about, is if you're somebody who's actively looking at building your portfolio, if you're actively saving, maybe you're younger, maybe it doesn't really matter, even if you're older, that you always have to have a watch list. Like, you have to have a watch list of companies that you're looking at, that you're interested in, paying attention to them, looking to see, do they get beat up? Do they not? And if you get an opportunity to go in there and basically invest in those companies. I mean, one of the companies that I follow pretty closely is Capital One Financial. I like the story. I like the investment thesis of that company. I like the fact that they bought Discover. I think that that's going to provide them with some pretty, good profitability in the future. They have moved down so much because of the Trump credit card only being able to charge 10% for a year, that I think it gives new investors a great opportunity to, I'm not saying you buy the full position at once, but you can start a position in a company like that because of that political headline risk that may or may not be there. So when you look at something like that, I mean, yes, Trump can say he wants to have 10% credit card, basically cap, but he has to have approval from Congress and places like that I'm just not sure that's going to happen. So, you can use some of that political rhetoric or whatever you want to call it, posturing from politicians and things they say. It provides you an opportunity to kind of get into companies when it moves around. And so I don't know, you just kind of got to use that to your advantage and not be worried about it, as long as you're in a position that you can hold that investment for a length of time. So we're definitely talking about making an investment and not just trying to trade, and hopefully it's good for 2 weeks. So we look at that. You see those. The other big headline definitely over the past week was the fact that Trump has nominated Kevin Warsh. I feel like my West Texas accent doesn't do a good job. Warsh, so Kevin Warsh, to be the next Fed chair. So a couple things have to happen here. He gets nominated. He's going to have to go in front of Congress, and he's going to get asked questions, and he's going to, try to get their approval so that he can be the next Fed chair. But the market this past week, when this was announced, the market really didn't have a reaction, which is kind of a good reaction, because he was a Fed governor back in the early 2010s during the first, basically during the financial crisis. And so he's been around the Fed. He's seen as somebody who is innovative. He's seen as somebody who is stable and somebody that can basically take the Fed in this, new direction or whatever. But obviously, Trump has made it very apparent that he wants interest rates lower, that he wants there to be lower interest rates. And so we'll see if that ends up happening. But the market definitely thinks so, which if it does, if the Fed lowers rates, that should be good for stocks. You'll see asset prices move up. Now, the big thing is going to be, does inflation follow behind that? And then we have what happened in 2021, 2022. So that's kind of getting ahead of ourselves, but that's kind of what the market looks at. And so, you look at some of the things that he's wanted to do, which is kind of lower banking regulations and ease money and lower the Fed's balance sheet, which would many people see as something that's a good thing. And so we'll see if he gets approved and how that's going to move forward. I'm sure that's going to be one of the major themes that we talk about as we discuss this year. This isn't something that would happen until May, so there's definitely a lot of time between now and then. A lot of other stories that could happen between now and then, so we'll see what goes on with that. I wanted to introduce you to a new company. I think that, I've listened to some of these episodes and I talk about, we talk about kind of the big companies, but I want to start talking about just different companies, introducing you to different companies that you might not necessarily be on your radar. The one I have today, I thought about this company, and then I thought, I don't know if I'm going to do it because they're expensive. This is definitely an expensive stock, but I thought it was one that I just think that you need to know about. And so this company, the ticker symbol is KLAC. So it's KLA Corporation is the name of the company. And what KLA does is they're basically the quality control of semiconductors. So when you make these semiconductors, KLA basically has a program that is able to detect any kind of defects that you can't see with the human eye. So think about that. You think about all these semiconductor chips that we've discussed. You know, you have NVIDIA making them, you have AMD making them, you have Broadcom making them, you have all of these semiconductor chips being made. And it's like, well, how do they tell if there's a bad batch or not? Like, how do they tell if there's some kind of defect before they make $1 billion worth of these chips to find out that they're not good or they're not usable? Well, that's where KLA comes in. So KLA basically is the quality control of this, where they can actually detect things that the human eye can't see, all of these things to make sure that these chips are working properly before they make, you know, the full run of the chips, and make sure that there's not any kind of defect. And so if you look at this company, you go look at their financials, and you'll see that their revenue has been going up steadily over the last couple of years. They're actually doing a $6 billion buyback using a lot of this extra cash that they're making to buy their own shares back. They still have $5 billion left on that buyback. The problem is that the stock's almost $1,500. And so, but if they continue to buy back those shares, that price is just going to go up. Now, they reported earnings on Thursday night. They had good earnings, but the stock sold off because we're seeing, I'm seeing that so many times this quarter, where a stock runs up into the quarter, where they basically, what I mean is they trade up every single day before they report earnings. They report earnings. It's a good report, and the stock still sells off because the quarter wasn't, you know, quote unquote good enough. And then slowly over time, you know, investors come in and start buying it up. So this is the investor versus trader, I think. So when you look at them, they dropped over $100, maybe even $130 on Friday based on this. But I would assume that this would be something that is pretty short-lived. They had some price target increases based on this quarter. And it just looks like, when I look at this company and you look at the number of semiconductor chips that are being made, it's like, this isn't a nice to have. This is I have to have this company's product in order to produce these chips. And so I like that because it's a company that, you know, many of you have probably not heard of. It's a company that many investors probably haven't heard of, but it's definitely one of those where, man, in order to produce all these chips that everybody needs, every company needs, and all of us need, you got to have this company. So that's KLAC is the ticker symbol again, KLA Corporation. And another one that I like was APH, Amphenol, another company that reported great numbers. They make electrical connectors and a number of different industries. That one got up to $166 before they reported, an all-time high. And then after they reported, it dropped back down to $150. So another one where good quarter, probably stock got a little ahead of itself. And so you get the chance to have it come back down, and the possibility to maybe, you know, buy some more shares, enter a position. And so you just kind of got to look for that as we see this going on. The other big quarter this past week was Tesla. And the big news on Tesla was that they are going to end their Model S and Model X production, which is a big deal because they're basically saying they need the production lines for humanoid robots. So I think that's something we need to talk about a little bit later, maybe a future episode talking about that. Musk has also hinted that he might, I don't know if this is true or not, but he might merge SpaceX with Tesla, which would just make investors so happy if he would do that. But we'll see. He's known to say things and then do something completely different. So that is definitely just a rumor and not something I have any kind of real information on, except for a couple news blobs. So, but anyways, another, you know, as we've seen before, man, there's no rest when it comes to the stock market. And so we just kind of get off and move right as the year starts to go. So we have February coming up. We have a lot more earnings to get to. I hope this has been helpful for you. Most important takeaway from today is thinking about your watch list. Think about the companies that you want to invest in. What are the companies that you think would be a good investment over the next 3 to 5 years? Start tracking those companies and looking for opportunities to be able to buy shares, to enter into a position, to add to a position. But just, you got to have the companies that you've already done research on, you already know you want to own, because when they make the moves, you got to already have all that background stuff done, the research, knowing you like the company, all that stuff needs to be done. So as always, I hope this was helpful for you. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Right R Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Past performance is no guarantee of future results.